Introduction. Hello and welcome to today's video, where we'll be discussing a topic that has been making headlines recently: the collapse of Silicon Valley Bank, SVB. SVB was one of the largest and most respected banks in the tech industry, but its sudden collapse has sent shockwaves throughout the financial world. In this video, we'll be taking a closer look at what led to the collapse of SVB, the impact it has had on the tech industry, and what lessons we can learn from this experience. Part 1. What led to the collapse of SVB? The collapse of SVB was a result of several factors, including reckless lending practices, poor risk management, and a lack of oversight by regulators. For years, SVB had been providing loans to high-risk tech startups, many of which were not profitable and had no clear path to profitability. Despite this, SVB continued to lend money to these companies, which led to a significant amount of bad debt on their balance sheet. In addition, SVB had been using complex financial instruments, such as collateralized loan obligations, CLOs, and credit default swaps, CDSs, to hedge their risk. However, these instruments proved to be highly risky and difficult to value, and when the market turned against them, SVB was left with significant losses. Finally, regulators failed to properly oversee SVB's operations, allowing the bank to continue engaging in risky lending practices and failing to intervene when red flags appeared. Part 2. The impact of SVB's collapse on the tech industry. The collapse of SVB has had a significant impact on the tech industry, which has relied heavily on the bank for financing. Many tech startups have been left scrambling to find alternative sources of funding, while others have been forced to shut down altogether. In addition, the collapse of SVB has led to a loss of trust in the banking industry as a whole. Investors and customers are now more wary of engaging with banks that engage in risky lending practices and use complex financial instruments. Part 3. Lessons we can learn from SVB's collapse. The collapse of SVB provides several important lessons for both the banking industry and tech startups. First and foremost, banks must be more responsible in their lending practices and avoid taking on excessive risk. They must also be more transparent in their operations and provide regulators with the information they need to properly oversee their activities. For tech startups, the collapse of SVB highlights the importance of focusing on profitability and building a sustainable business model. Startups should avoid relying too heavily on debt financing and instead focus on raising equity from reputable investors. Finally, regulators must be more vigilant in their oversight of banks, particularly those engaged in high-risk lending practices. They must intervene when red flags appear and ensure that banks are operating in a safe and responsible manner. Conclusion. In conclusion, the collapse of SVB has been a wake-up call for the banking industry and tech startups alike. It highlights the importance of responsible lending practices, transparency, and oversight. By learning from the mistakes of SVB, in this video, we'll be discussing the key lessons we can learn from SVB's collapse and how they can be applied to prevent future banking failures. Lesson 1. Banks must be responsible in lending practices. The collapse of SVB highlights the importance of banks being responsible in their lending practices. Banks must avoid taking on excessive risk, and instead, focus on providing responsible lending options that benefit both the bank and the borrower. Lesson 2: Transparent information to regulators. Banks should focus on providing transparent information to regulators to properly oversee their activities. This transparency is essential to prevent any regulatory issues that could lead to a bank's collapse. Lesson 3: Startups should focus on equity. Startups should avoid relying too heavily on debt financing and instead focus on raising equity from reputable investors. This approach ensures that the startup maintains control over its operations and avoids the high risk associated with debt financing. Lesson 4: Focus on profitability. Companies should focus on profitability and building a sustainable business model. This approach ensures that a company can continue to operate in the long term and avoid financial difficulties that could lead to a bank's collapse. Lesson 5: Diversify funding sources. Tech startups must diversify their funding sources to avoid over-reliance on a single institution. This approach ensures that the startup can weather any financial storms and avoid the risk of a bank's collapse. Lesson 6: Regulators must intervene. Regulators must intervene when red flags appear and ensure that banks are operating in a safe and responsible manner. This intervention ensures that banks are not engaging in any practices that could lead to their collapse. Lesson 7: Risk management policies. Banks must have proper risk management policies in place to avoid overexposure to high-risk assets. This approach ensures that banks are not taking on more risk than they can handle and are operating in a responsible manner. Lesson 8: Complex financial instruments should be used with caution. Complex financial instruments such as CLOs and CDSs should be used with caution as they can be highly risky and difficult to value. Banks must ensure that they understand the risks associated with these instruments before engaging in any transactions involving them. Lesson 9: Rebuild trust with investors. The banking industry must work to rebuild trust with investors and customers through responsible practices. This approach ensures that the industry can continue to operate in a responsible and sustainable manner. Lesson 10: Focus on profitability and scalability. Startups should have a clear path to profitability and a plan for scaling their business. This approach ensures that the startup can continue to operate and grow over the long term, avoiding the risk of a bank's collapse. Lesson 11: Hold bank executives accountable. Bank executives should be held accountable for their actions and decisions that may lead to the collapse of the bank. This approach ensures that executives are not engaging in any practices that could lead to a bank's collapse. Lesson 12: Monitor the use of leverage. The use of leverage must be carefully monitored to prevent excessive risk-taking. This approach ensures that banks are not engaging in any practices that could lead to their collapse. Sustainable business model. Startups should avoid relying too heavily on debt financing and instead focus on raising equity from reputable investors. Finally, regulators must be more vigilant in their oversight of banks, particularly those engaged in high-risk lending practices. They must intervene when red flags appear and ensure that banks are operating in a safe and responsible manner. Conclusion. In conclusion, The collapse of SVB has been a wake-up call for the banking industry and tech startups alike. It highlights the importance of responsible lending practices, transparency, and oversight. By learning from the mistakes of SVB, we can build a more resilient and sustainable financial system that benefits everyone. Thanks for watching, and we'll see you in the next video.